Hello, everybody. It's Hammer with this week's mortgage market update. Joined with are you like a video virgin, Brandy? Have you not been on any of these, or do you just not love being on these?
I just schedule these and I make sure our VBA moderators and admins show up to these. I've never actually hopped on one.
All right, everybody. So, everybody, please welcome Brandy Alongi. Did I say it right? Is it Alongi? Do you
It's
use a
close
hard
enough.
G?
It's a
Oh,
hard G. Yeah.
all right, good. So, well, why don't you go ahead and thank you for joining us and tell everybody a little bit about your role and what you do here at Vetted VA and about yourself as an originator.
Yeah, so I joined Vetted VA straight out of my separation from the Air Force. I came in as an admin with zero background in the industry. And after watching how the moderators really just kind of taught the entire group and how we focused on education, I was like, this is cool. I want to do this. So, about a year ago, actually, I got my originator license and now I'm wearing both hats.
Awesome. Well, thank you for joining us. And for those that are following along, Brandy is a little bit nervous. And I said, Brandy, this is a great opportunity because if you have questions, we have so much to talk about today. And I said, Brandy, if you have questions, everyone else has those same questions. So, Brandy, the rule is there's no dumb questions, only dumb people, and dumb people aren't on this show. So you
Perfect.
can go ahead and ask any question and interrupt me and ask away because everybody else is also going to have that same question. So, but and speaking of questions, everybody, if you go ahead and have questions, let's hear them. In fact, if you are here live, do us a favor, say hello. Let me know if you are a consumer or a Vetted VA professional. It looks like we have two people on the Vetted VA for Professionals Facebook group on right now. So, but if you are not here live, I know many of you can't make it live, but don't worry, we do track down the replay. So do us a favor, just give us a hashtag replay. Let us know that you're here on the replay. If you do have any questions, feel free to post them up there. And Brandy, along with the rest of the moderators, will make sure that we see them and answer them for all of y'all. And there we go. So let's go ahead and jump right in, Brandy. Then we're gonna talk about rates. And when we talk about rates, remember everybody, this is not an offer to lend. When we talk about rates, we're talking about averages and generalities. You should always shop around and shop your rate. But rates are likely to get crazy over the next couple of days. I'm going to tell you why in a moment. So, what we said last week, in case you missed it, Brandy, I said rates could be cresting, meaning we had seen some improvement, and I felt like we might not get much more improvement from that point, and that we could creep up from last Wednesday if the technical indicators were correct. And for those of y'all that follow at home, when I talk about the technicals, I'm talking about all these fancy colored candlesticks. They call this a Japanese candlestick chart. And when we look at this and we read the tea leaves, it kind of said, hey, we may be seeing things at the end of the rope here. I said there wouldn't be any real big moves ahead of the Fed meeting May 3rd, which is today. And I said that May could be a very good month for mortgage rates if things go our way. So what did we actually see and what actually happened? Well, here is a quick recap of what we saw. Rates did move higher last week. Not a lot. Brandy, have you been following along on rate sheets? Did you see, rates that you're quoting consumers move a lot, or maybe an eighth or a quarter%?
It wasn't a ton. It was at maximum a quarter. It was more so we were at the same rates. We just didn't have as good of pricing.
Right. So, and for those of you following at home, sometimes when we talk about pricing in the industry, we mean the credit that we can give you towards your closing costs as a lender, or the costs that it's going to cost for you if you want to improve your rate by buying it down. And sometimes that's called points. So a lot of times over the last few years, people have become very, I guess, complacent with mortgage rates, and they're used to mortgage rates staying very consistent or moving slowly. And that's because the markets have been, for lack of a better word, manipulated by the Fed. And the Fed was buying up mortgage-backed securities, which is actually the basis of where mortgage rates come from. And that's why we've seen mortgage rates that over the last few years, you didn't see these moves of an eighth or a quarter%. In other words, for if you're a consumer, you might have seen 6.25%, and then maybe 6.25% became 6.375. That's an eighth of a point increment, and that's generally when you see mortgage rates move, they move an eighth of a point. So you said you saw just maybe an eighth of a point, but generally not too big of a move over the last week, though.
Correct. Yeah, they weren't going down. I did see them kind of creeping up, but nothing.
They were creeping up. And so basically, what happened over the last week, as Brandy said, rates crept up a little bit. Markets were anticipating the Fed was going to go ahead and raise rates at today's meeting, and that's still the consensus, and we'll talk about that in a minute. But they were expecting that the that we would see a pause and possibly some rate cuts. So that's actually improved. And for those of you that have watched this show more than once, I like to use this particular graph, and I want to give y'all the tools that you can follow along at home and see what I see. So if you type in CME Fed futures, right? If you just Google CME Fed futures, you will get the CME Fed Watch tool, and it's a free tool. And that's what I'm showing you guys here on the screen. And what this shows us is basically what are markets betting on? What are they looking to have happen? And at this meeting today, there is currently an 86.8% probability in the markets that the Fed is going to go ahead and raise rates. So basically, this is almost like betting on football. And this is the spread. And right now, there's a small amount that are betting that, hey, we could see the Fed actually punt and not raise rates at this meeting. But it's a very, very unlikely scenario. Not a lot of people get behind that. The consensus is that we're going to see a rate hike at this meeting. What's different, though, is even yesterday afternoon, we saw, I'm seeing a lot of whipsawing in the Fed futures market and in the markets. In other words, the markets are like, okay, the Fed, maybe they're going to stop, but maybe they won't raise rates until November. I'm sorry, they won't cut rates until November. And that was the consensus as of Monday when interest rates were higher. And that's not a coincidence. So interest rates were higher on Monday. The markets were pricing in that the Fed would start to cut rates by November. And then rates have improved over the last couple of days. We saw a big jump yesterday. Rates actually improved about 1/8 of a point yesterday, which is a lot for one day. And part of what we saw happen at the same time is we saw this idea that the Fed would go ahead and pause those rate hikes in June. And then possibly late yesterday, they were even looking, there was a 25% probability that we would see a 4.75 Fed funds rate, meaning the Fed would actually have to cut rates in June to get to that number. That's a little less likely right now. It's not quite as anticipated, but we're going to see these charts move a lot between 2 and 3:30 p.m. Eastern time today. So in about 2 to 3 hours, we're going to see these charts move. And the reason for that is that the Fed is going to come out with their Fed statement at 2 p.m. Eastern time. And we're going to have a press conference for Fed Chair Jerome Powell at 2:30 p.m. Eastern time. So, Brandy, let's get you involved. What questions do you have about mortgage rates and the Fed, or what questions are you representing that maybe our Vetted VA community has?
Yeah, so I actually had this conversation yesterday with a shopper, and they said, well, what do I do? Do I lock, or do I risk waiting to see what 2 p.m. does? And so that's where it's the big question of what do we do? What should we do if we're in the home buying process right now?
Okay, great. That's an awesome question. So for everybody, that question, just to repeat it, was, should I lock or float if I'm in the home buying process? And for me, I've got 23 years experience in the industry, 10 years as an originator, giving advice about locking and floating, and then the rest of it giving other originators advice on locking and floating. And what the first thing I like to do is look at, when are you actually anticipating to close your transaction? And I break that down into a couple of weeks. So if somebody was closing in the first half of May, they've got a lot less time for things to move. If rates go up, do they have time for rates to come down? We don't usually see those movements. Let's say rates do move up today. We generally are going to see it's going to take about a week, maybe 10 days for rates to improve after they go up, even if they stop going up. So somebody that was closing in a couple of weeks, you'd have to normally, I would say, okay, well, you want to be more conservative and generally look at locking in to protect your interest rate, unless we're very, very strongly believing that things are going to improve. Now, people that have more time, if they're closing in 30 days or longer than 30 days, you have a lot more time for the market to go up and down. And the market is very cyclical. And if we look at, I'm going to bring it up on the other screen, I'll show you guys those fancy charts. When we look at a Japanese candlestick chart, and I'm going to put this one up to 6 months here, you'll see that there's a certain ebb and flow, that things go up. And as these candlesticks go higher, that's when mortgage rates actually improve. Then they go down, then they go up, then they come down, then they go up, and they go down, and they go up and down and up. And you guys are sensing the pattern here, right? It's very cyclical. The question is how big are the swings and how long do those swings last? For example, this was the month of February. At the end of January, we had some of the best rates we'd seen in months. And then and through the entire month of February, it went from bad to worse. And that's why you see this is a very long downward trend and a very long downswing. So if you were closing in 15 days at the beginning of February, well, it just got worse and worse and worse. And that's why sometimes it's a little bit better to be conservative. But if you've got longer time, well, what happened? We saw a recovery. Rates got better again. It took until the end of March, but we did see quite a bit of improvement from the worst rates that we saw in February. In fact, in February, conventional conforming rates pushed up into the sevens, and VA rates were in the high sixes or even in the low sevens. So we saw that improve from there. Now, the question, to be more specific, was, well, what do we do going into this Fed meeting? Well, there's another variable that comes into play. A lot of times we get data early in the morning. Most lenders, they set their rates. What time do lenders generally set rates for you, Brandy?
So I'm Central Standard Time. I usually start seeing them flow in at about 10 a.m.
Okay. So, and that's what happens is a lender is actually going to set a rate sheet, and it's electronic now. We used to actually get paper rate sheets. But I mean, back when, when I used to do applications in dinosaur bones, but yeah, so they set their rates generally at about 10 a.m. Eastern time. And, even Central, you're seeing those rates come in. So generally between 10 and 11, you'll see a lot of those rates set. So if we have data that comes out early in the morning, like on Friday, we're going to get the BLS, which is the Bureau of Labor Statistics. We're going to get the BLS jobs data. That's a big economic report, and the Fed is going to be watching closely to see what's happening in the labor market. That means the markets are watching closely to see what happens in the labor market. So if that report comes out at 8:30 a.m. Eastern time and rates come out at around 10 a.m. Eastern time, the problem is in that limbo, you can't lock. Right? Unless it's a brand new loan and you have what's called overnight protection, a loan officer or a mortgage pro like Brandy, what happens is the lock desk closes the night before, and then they don't reopen that window for you to start locking loans until, like you said, maybe it's about 10 or 11 a.m. Eastern time. So if we get data at 8:30 a.m., if it's really bad, then that means that next day's rate sheet is going to reflect that movement in the market. So, for example, maybe the rate quote was 6.25 on Tuesday, and then Wednesday. Well, we use Friday since the job day is coming on Friday. So on Thursday, maybe it's 6.25, and then Friday, maybe we get a really strong jobs data report showing a lot of new jobs were created, which sounds great, but unfortunately, it's actually very good for the economy, which makes it inflationary, which means it's bad for mortgage rates. And let's say that those mortgage rates, instead of 6.25, let's say it comes out at 6.375. Now you as a consumer, you're stuck with that higher rate. So when you get a report in the morning, you're gambling going into it the night before. The Fed meeting, though, is one of the rare occurrences that happens in the middle of the day. So I would have yesterday floated, and that's what I've been, counseling all of our originators to do, is to counsel their consumers. Last week, around the middle of the week, when things had kind of crested, as in my opinion, I thought we were seeing the best rates, I said to originators to share with their consumers, hey, you've got to make a commitment here. You're either committed to floating into that Fed meeting, which was a week away, no matter what. Rates got a little bit worse, then rates got a little bit better. We were going to float through that whole thing for today, or last week was the time to lock in. So somebody that would have asked yesterday, I would have said, well, we missed our window to lock. We wanted to do that last Wednesday or maybe last Thursday. Now let's float to this meeting. We don't know that it's going to be better, but we have a really good opportunity that it could be. And if it's not, you can generally, by following the market reaction, and that's why I got all those fancy charts here, we're going to see at 2 p.m., we're going to see a lot of movement here. And right now, mortgage-backed securities, these are a bond, and they're selling for 101.03. That's what they're trading for. And I know that that's jargon, and it's over a lot of people's heads, but here's the simple answer, is that right now, it's 101.03. It's up what we call 39 basis points for the day, meaning that it's selling for more money than it was at the beginning of the day. If it continues to go up and sell for even higher, that's good for mortgage rates. If it goes the other way and starts to drop in value and turns red, that's going to be bad for mortgage rates. So at 2 p.m., we're going to see a reaction depending on how the markets react to the Fed's statement. And, if you want to know, well, what's the Fed going to say? We can kind of bounce into that one next. I'll go to this article, but let's stop there. Did I answer that question about locking or floating into the meeting or into other events? Okay.
No, that was perfect. Thank you.
Okay. What other kinds of questions do you think that other people have that we should answer?
I mean, I really think that's kind of all dependent on what the market does. I mean, if rates get better, we're going to start getting the questions of, if I'm already locked, can I float down at this point? But that's not going to be a factor unless we get better,
Better rates, right?
improvement. Yeah.
And let's explain to everybody what that means. So generally, when you lock in an interest rate, it's a commitment. It's a commitment that the lender is going to guarantee that when you go to closing, that's the rate on your loan. But in turn, it's also a commitment from you as a consumer that you've now committed to that interest rate. And if interest rates get better, well, you don't get the better rate. You've committed to that higher rate. And there's a reason for that. I could go into the whole back end and the secondary and how this whole thing works with money, but let's just take it for face value that that's how it works. Now, however, there's also some competitive nature amongst mortgage companies and mortgage lenders. And if our rate is too high because we locked it in and rates get really significantly better, and when I use the word significant, it means more than a quarter on average. So if you locked in at 6.5 and rates drop to 6.125, well, your loan officer may have the opportunity to help you to float down. Brandy, what is a float down?
It's where we essentially take the rate and float it down farther.
Yeah, bring it back down, right? So there's usually some parameters for that with most lenders. They're going to require that the move was very significant. And part of the reason they require that is because they're going to lose money. They have basically, it's like borrowing money from the mafia, right? So, this has moved its way up the chain. And I've lent money to Brandy, or I've committed that money to Brandy. Brandy, is all locked in. Now I am going to say, okay, I need to hedge myself. I'm going to go to the next guy up the chain and I'm going to lock in with them. And I'm going to promise to sell my loan to them at this interest rate. Well, if rates drop and I can't deliver, well, I'm going to get my kneecaps busted. So it happens to be a economic kneecap busting rather than a true kneecap busting, but it still happens. So I still am on the hook for that loan that I promised up the chain. And I need to see enough of an improvement that I can make a little more money so I can buy myself out of that, getting kneecapped, because no one wants to get kneecapped. So that's kind of how it works when you do a float down. And depending on the lender, some lenders, if you're dealing with a mortgage broker, they may have the opportunity to actually change lenders. Some lenders, direct lenders, will have different circumstances that they can float down that rate. I don't think we're going to come into that in this meeting. I think we're going to see a more gradual rally. I think we do have the opportunity to see rates improve in May, but I don't think we're going to see, if someone locked in this morning at 6.25, I don't think that they're going to wake up tomorrow and rates are going to be at 5.5. So,
right.
So let's talk a little bit about what is everyone going to be looking at today. And if you're a consumer, what should you be looking at? And let me show you all a little bit about that. So basically, this article kind of sums up what the market's going to be looking at. They're going to be looking at what is actually said in the statement itself. And it's so funny because this is like me arguing with my wife. All right. Just one or two little words makes a huge difference. If I say, honey, how are you? And she says, fine. Well, fine doesn't always mean fine. And it's kind of the same thing with the Fed statement. When they put things in here, they're going to say things like data dependent, or they make small word differences. And in other words, in March, officials tweaked the statement to say that some additional policy firming may be appropriate. And that was the quoted verbiage that they used. Some additional policy firming may be appropriate, softening previous language, which was that ongoing increases would likely be needed. So they'll make very small moves like that. The Fed does not want to upset the markets, the stock market, the bond markets, trading, and they don't want to make any big disruptive moves. They want to give small indicators, but they don't necessarily want to show their hand. So today, they're going to come out with a statement. And in that statement, they're very, very likely, and as we've seen, it's about a 90% probability that they're going to raise that Fed funds rate, which is currently at 4.75 up to 5%. And then they're going to come out with a statement, and they're going to talk about the different economic conditions, what's happening in the banking sector and how much of a concern that is, and what they think is happening with inflation. And they're going to use words like data dependent, but they're going to give some signals to the market that, hey, we're slowing down and we're ready to take a pause here. And that's most likely, that's what the markets are currently expecting to hear and what they're pricing in for June. Now, if that statement were to say, we're unhappy with the way that things are going with interest rates and with inflation, and we think we need to be very aggressive. If they said something like that, very unlikely, but that would shake things up, and we would see mortgage rates go higher very quickly. We would get a jump in rates because everybody would panic, and they would say, okay, this was not what we've got on the agenda. This is not what we've speculated. And they would think that, hey, things are getting worse. Mortgage rates are going to react very quickly to that speculation. If the Fed were to come out and say, hey dogs, we're done, we're pausing, which again, they're not going to say. If they did, then we would see, it would be like that scene in The Wizard of Oz, and everyone's running around about how the witch is dead and everyone's excited, and that's not going to happen either. So we're looking for something in the middle. Now, it's a 1-2 punch, though. We get the jab at 2 p.m. with that statement, which comes from the Fed as a entity. And then at 2:30 p.m., we're going to get a press conference with Fed Chair Jerome Powell. And that's actually broadcast live on YouTube. I won't say it is the most riveting of things to watch. I mean, it's certainly not Yellowstone, and you're not going to binge watch the last 3 meetings, but I do like to actually listen to what Fed Chair Jerome Powell has to say. Markets are going to react to that. So we will see between 2 and 3:30 p.m. today, we're going to see an opportunity where mortgage rates could get worse and then better. They could get better and better. They could get better than worse. I know, like, you're like, hey, Hammer, thanks for nothing. But it's all reactionary. It all depends on what the Fed says, what Fed Chair Jerome Powell says, the questions that are asked, and how markets perceive it. If markets think that the Fed is going to be forced to cut rates, even if the Fed says, no, we're not going to do it. If the markets think they're going to have to do it, we're going to see mortgage rates improve a little bit. If they think that the Fed is not necessarily giving them that vibe, where, we went out on a date, we're just not getting it, no second date in the cards, they're going to get upset about that. We'll see rates get a little bit worse. What you can watch to see on that is you can watch the 10-year yield. And the 10-year treasury is oftentimes associated with mortgage rates. It's not what is actually what mortgage rates are based on, but it's actually, I call it the granddaddy of bonds, because it's kind of the starting point. And when you see movement there, it's most likely you're going to see movement in what we call mortgage-backed securities that we're actually following. And that's why we follow the 10-year treasury yield and those mortgage-backed securities. So you can just Google 10-year treasury and you can find it on CNBC or Yahoo Finance or anywhere else. Right now at 3.37, if this yield goes down, that's good for mortgage rates. And you may not see mortgage rates improve today or tomorrow, but overall that will be good for mortgage rates. If we see this yield go up, whereas it might go up to 3.5 something, right? If we see a big jump, you're going to expect to see your lender knocking on your door saying, hey, remember that 6.25 I told you about this morning? Yeah, that's gone. Now we're up to 6.375, and it could get worse. So if y'all want to kind of get a jump on that, something that you want to be watching, watch that 10-year treasury yield. If we see improvement where that number goes down, that's good for mortgage rates. If we see where that number goes up, that's going to be bad for mortgage rates. You could also watch that CME Fed Watch tool. This will be a little bit slower in changing. It's not necessarily in real time. We want to look and see, when does the markets expect the Fed to drop rates, and what would those rates look like? So right now, in July, there's about a 40% expectation the Fed will be back down to 4.75. There's about a 55% expectation we'll be at 5. If this column goes down and this column goes up, mortgage rates have an opportunity that they may get a little bit better. So now today's Wednesday. We're going to get a lot of movement today. But then we've got what comes on Friday. So Friday is that jobs data. And the jobs data, basically, if people are making money, if jobs are good, that means more money is being spent in the economy. That's inflationary. That means the Fed would likely have to, continue to raise rates fighting inflation. All of this is unfortunately good for people as a person, because nobody wants to lose their job, but it's bad for mortgage rates and different things. If we see some stabilization where there's not so much demand, like right now, we called it the Great Resignation, where people could, quit their job and find a new job very quickly. If we find that starts to slow down, there's not as much of a hunger or an appetite, businesses are cutting back. Well, that means that the labor market, if unemployment starts to creep up, wages start to fall a little bit, that's going to be very good for inflation. That would be good for mortgage rates. And we're going to get that data on Friday. So, today could be a really good day for rates. Thursday could be a really good day for rates. And if you were closing in that window we talked about of the next 15 days, maybe you want to lock in that interest rate if it's really good. Don't get greedy. In the business we talk about, I don't know, Brandy, you've been a loan officer for about a year now, you said?
Roughly, yeah.
Okay. So I don't know if you ever heard the term. We talk about there's bulls and there's bears in the markets. And we say, bulls win and bears win and pigs get slaughtered. So basically, if you're a pig, if you're greedy, if you're trying to squeeze every ounce out of it, it's a lot of times that you're going to get burned. So if I was closing at the end of May or in June, I wouldn't worry too much about Friday's jobs data. But if I was closing the second week of May, I might lock on Thursday and just take what's on the table. Again, that's presuming that today's a good day. Take what's on the table because it could be risky going into Thursday or into Friday's data. And then by the time we have our next meeting, and I'm running long today, so we'll wrap up in a minute, but by the time we have our next meeting next Wednesday, we're going to have one more huge report, and that's the CPI consumer inflation report that's going to come out at 8:30 a.m. on May 10th. And that one could also be really good to help mortgage rates improve, or it could be one where we kind of go, oh, that sucks, and mortgage rates get a little bit worse. So that's kind of the different things. What do you think, Brandy? Anything else we should ask or talk about?
I don't think so. It's just kind of a waiting game at this point to see what happens.
Yeah. And see, it wasn't so bad sitting there watching me talk, was it?
No, I just thought you were going to make me do more talking. I just wanted to watch you teach.
I'm sorry. And we try. I do try to, we usually bring a lot. There's a lot to talk about today, though, especially because not only is today that Fed day, but then we've got Friday's jobs data. We've got next week's inflation data before we get to the meeting. So next week, we're going to have a lot to talk about, too, because we're going to look back and say, well, how did it play out? And everyone's got an opportunity. May could see mortgage rates. We could see some of the best rates we've seen this year if things go our way. And that's the big thing is, will things go our way?
Perfect. Well, I'll make sure one of our moderators hops on with you next week so you're not stuck staring at me again.
Awesome. Well, I loved having you on, and thank you. And I'm sorry we couldn't make you talk more. We'll get you on again and get you to talk more. And thank you, everybody. If you guys have any questions, hopefully you found today useful. If you did, please put it in the comments. Let us know that you like the content. If you have any questions, again, go ahead and tag me or any of our moderators can help you. And we will do this again, same bat time, same bat channel next week, 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. I like it when I'm in the West Coast because I feel like I have so much more day. I'm like, because I'm up at like 6 and everyone else, you're on that East Coast thing going. I'm like, this is awesome. And then I'm like, the day's over by 2:00. Now I know why California's so laid back.
Right. Central's where it's at. You get the best of both worlds.
There you go. I like my East Coast time. I'm good with this. So, all right, everybody. Well, thank you. And thanks, Brandy, for joining us.
Thanks, Hammer.